A. Define capital budgeting and identify the steps in developing and implementing a capital budget. Capital budgeting is the process of evaluating and selecting long-term investment projects that are consistent with the firm's goal of maximizing shareholder value. These projects typically involve significant initial expenditures and long-term cash flow consequences. The process begins with identifying potential investment opportunities aligned with strategic objectives. Proposals are screened and analyzed using financial evaluation techniques. Relevant cash flows are estimated and discounted to assess project feasibility. Management compares alternatives and selects projects that meet required return thresholds. After approval, implementation and post-audit review ensure performance aligns with projections and strategic expectations. B. Identify and calculate relevant cash flows on pre-tax and after-tax basis. Relevant cash flows include incremental cash inflows and outflows directly attributable to the project. Sunk costs are excluded, while opportunity costs are included. Initial investment includes purchase price, installation, and working capital changes. Operating cash flows reflect incremental revenues minus incremental expenses. Pre-tax cash flows focus on gross amounts before tax impact. After-tax cash flows adjust for tax effects on operating income, depreciation tax shields, and asset disposal gains or losses, providing more realistic project evaluation. C. Demonstrate understanding of how income taxes affect cash flows. Income taxes reduce net operating cash flows by applying the corporate tax rate to taxable income. Proper tax adjustments are essential for accurate project analysis. Depreciation creates a tax shield by reducing taxable income. The tax savings equal depreciation multiplied by the tax rate. Gains or losses on asset disposal affect final cash flows through tax consequences. Changes in tax laws can significantly influence project viability. After-tax cash flow analysis ensures capital budgeting decisions reflect true economic profitability rather than accounting earnings alone. D. Distinguish between cash flows and accounting profits, relevance of incremental cash flow, sunk cost, and opportunity cost. Capital budgeting decisions are based on cash flows, not accounting profits. Accounting income includes non-cash items such as depreciation and accruals, which do not represent actual cash movements. Incremental cash flow refers to the additional cash inflows or outflows directly caused by undertaking a project. Only these incremental amounts are relevant for evaluation. Sunk costs are past expenditures that cannot be recovered and should not influence decision-making. Opportunity cost represents the benefit foregone by choosing one alternative over another. Focusing on incremental and opportunity cash flows ensures decisions reflect true economic impact. E. Explain the importance of changes in net working capital in capital budgeting. Capital projects often require additional investment in net working capital, NWC, such as higher inventory or receivables. This represents a cash outflow at project initiation. Although not an expense, increased NWC ties up funds that could be used elsewhere. T. the end of the project, working capital is typically recovered, creating a terminal cash inflow. Failure to include NWC changes can misstate project profitability. Accurately estimating timing and magnitude of working capital changes ensures more realistic cash flow projections and investment decisions. F. Discuss how inflation effects are reflected in capital budgeting analysis. Inflation affects both projected cash inflows and outflows by increasing prices, costs, and revenues over time. Ignoring inflation can distort project evaluation. Nominal cash flows should be discounted using nominal discount rates. Real cash flows must be discounted using real rates. Consistency between cash flow estimates and discount rate is critical. Inflation may impact operating margins differently depending on cost structure. Careful treatment of inflation ensures more accurate measurement of purchasing power and long-term project viability. G. Define hurdle rate. The hurdle rate is the minimum required rate of return that a project must achieve to be accepted. It reflects the company's cost of capital and risk profile. Projects with returns above the hurdle rate create shareholder value. Those below it should generally be rejected. The hurdle rate may vary depending on project risk. T is commonly based on the weighted average cost of capital, WACC. Establishing an appropriate hurdle rate ensures disciplined capital allocation and alignment with strategic financial objectives. H. Identify alternative approaches to dealing with risk in capital budgeting. Risk in capital budgeting can be addressed by adjusting expected cash flows or modifying the discount rate. Conservative cash flow estimates reduce optimism bias. Risk-adjusted discount rates increase required returns for higher-risk projects. Certainty equivalent methods adjust risky cash flows into guaranteed equivalents before discounting. Shortening project horizon or staging investments reduces long-term exposure. Managers may also use diversification, insurance, or contractual safeguards to mitigate operational and financial uncertainties associated with major capital projects.